Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Drew Senulis. Thanks for being on the show, Drew.
Thank you for having me.
Yeah, honored to have you on the show. I don't know many people have has as many degrees and experience in commercial real estate as Drew does, and then he went and became an attorney. So it's an incredible background and just experience that he has. So pleasure to have you on the show. A little about he's the most tenured attorney. Drew and Patel Gaines has represented clients in over 1.5 billion. In business and commercial real estate transaction, has more than 15 years of prior real estate related experience before becoming an attorney, including management of an approximately $85 million commercial real estate portfolio. He has been featured in US Today, Business Week, Texas Lawyer, and the San Antonio Business Journal, where he was named a C-suite executive awardee 40 under 40 in the Outstanding Lawyers list and was their Man of the Year. That just sounds cool, by the way. He has also been featured in USA Today, Business Week, Texas Lawyer, and more. Drew, welcome to the show. I know you have many unique abilities. You have many just layers of experience in this industry. But why don't you give us, a quick background? I know we can't go in depth in all those degrees that you have, right now. But give us just a short background of how you got to the attorney seat that you're in now, and then let's dive into some of your unique abilities, superpowers that can help the listener today. On the legal side, in their commercial real estate deals.
Yeah, so it started for me at a very, very young age. My high school job, my father was a civil engineer and an architect. And so my high school job was I went to work for him. Started out surveying out in the hot sun for many hours a day, during the summer. And eventually in high school, I actually became a computer-aided drafter. So I was a draftsman. I drew plans, and then from that, I went to college for what many people would tell you forever. Got multiple undergrad degrees, got a degree in real estate finance and development, got a degree in finance, have a degree in math, so went the college route, graduated from college and went to work in San Antonio, Texas for a real estate developer who, I managed, oversaw, a large portfolio of multifamily, general kind of retail, commercial, office building, medical office building, you kind of name it. And also ended up through that in the construction field and was a general contractor. And I built multifamily and a lot of hospitality. And so after all of that, I decided, my goal was really always to go to law school. And so with that experience, then I actually enrolled in law school, graduated from law school. And, I've been here at Patel Gaines since I was in law school, graduated law school. And so really my experience, what I tell people is there's not a whole lot in the commercial real estate world I haven't seen, whether as an attorney or personally. And I think that's the difference is I think some attorneys get on the legal side of things, but they have zero idea on how things actually work behind the scenes. And so I've seen both sides of that ledger.
No, that's some great experience. And I think even as an operator, working with an attorney that has that experience is very valuable. To say the least, right? Most, I guess, are very focused on becoming an attorney, right? As soon as possible. It's neat that your goal was always to go to law school, but that you gained all that other experience beforehand. And I'm sure that's paying forward now, in many ways. So there's so many things we could talk about, right, on the legal side side of this business. But one I know we wanted to start with today, was just, what to know when dealing with Fannie and Freddie. And I know getting into this business, it can seem kind of overwhelming, right? When you think about, getting a loan from Fannie and Freddie, or even, just the legal implications. What does that mean? How do we make that happen? I wanted to just, jump right in there from a legal perspective and how to deal with Freddie and Fannie and how to think through that.
Yeah, and I think the biggest thing I see, especially from if it's a new investor, for some reason there seems to be some misconception to new investors that maybe Fannie and Freddie isn't available, and or that Fannie and Freddie are direct lenders. So really, all Fannie and Freddie are buyers of loans. They don't originate loans. They don't loan money. You work with whoever your traditional lender is. Now, your lender has to meet certain thresholds and criteria for Fannie to buy loans from them. But I think one of the bigger, not too long ago, I had a new group who kind of wanted to get started in the real estate. And, Fannie Freddie came up and there was we can do that. I mean, I thought that was kind of a secret, that you had to meet these certain things. And the answer is no. If you're in the multifamily sector, and your property meets the underwriting requirements, for the most part, there's a good chance Fannie or Freddie will buy the loan, and it gets you better rates. It gets you better terms because it limits the exposure of the actual originator, the bank, or whoever loaning you the money.
So you talked about like the property having to meet specific requirements. I thought maybe you could speak to a few of those requirements and even requirements for the operator to be able to, to use something like a Fannie or Freddie loan.
Yeah, and so it depends a little bit on your structuring, but for the most part, Fannie Fannie is going to be what we would consider kind of a conventional, 5 to 30 year term, 5 to 30 year amortizations, a full 80% LTV. Those are going to be, it's going to be your traditional, more traditional type financing, what they call conventional. And you're going to have to meet those thresholds. Right now, I think on a conventional Fannie, I think they have a 1.25 DSCR, debt service coverage ratio. So the property is going to have to actually generate 1.25% of whatever that debt service is, your mortgage payment. And there's a couple of things that work into that calculation. And they're going to do that. So one of the difference between maybe a Fannie is they're a little bit more conservative because they're basically insured by the institution that is Fannie Mae. They're going to use actual income versus some of your non-Freddie, non-Fannie debt, traditional lender. They may allow projections. And so some of the thresholds are, like we talked about, 80% LTV. I think it's right now 1.25 DSCR. You're probably going to have pretty close, if not over 90% occupancy. So it needs to be stabilized property. Now, all of this, and one of the other big misconceptions I run into, and it's really kind of weird because there's two misconceptions and they completely contradict each other. One misconception I get from clients is you can't do anything to a Fannie loan. They are what they are, set in stone. That's not true. And then the other side is, well, it's just like any other loan and we can go and negotiate. The reality is it's somewhere in the middle. However, usually the negotiating with Fannie is a process. It's like a government process, and it literally takes a committee. And so what the trap we run into with clients when they're buying and they're trying to get Fannie modifications is they simply haven't built in enough time in their purchase agreements to allow that to actually happen. Because it can be a 30, 60, 90. During coronavirus last year, we had some that would take 6 months. And so there's just not enough time. And so now they're up against the wall that they have to close. Most sellers aren't willing to give extension after extension. And so the reality is, yes, you can negotiate and modify with Fannie. It takes a while, and most of the time it's just not feasible from a temporal aspect to do it.
So know who your lender is ahead of time, right? I mean, which I hope you do anyway. I hope you're having those conversations with your lenders, but you need to understand some, I guess, realistic terms and realistic timeframes, and I would say even speaking to other operators that are dealing with those lenders, particularly at that same time, it may be valuable as well. Drew, anything else as far as pros and cons, going after agency debt like that you could share with the listener?
Yeah, so I mean, I think the pros are pretty well known. The pros are you're going to generally get the best terms the market has to offer. You're going to get the full amortization fixed rate at whatever prevailing markets are. The cons are, again, it depends on what your strategy is. I mean, if you're a value add multifamily guy who's coming in and buying, a $10 million multifamily or $5 million multifamily deal, but you're going to put $1.5 million in it, and you're at 60, 70% occupancy right now, but that's your goal, is a 1, 2, 3 year goal, put money into it, get rents, stabilize occupancy, and then sell it. This isn't the deal. Fannie's probably on the business side not going to work for you, number one. Number two, you won't qualify. You won't meet the occupations. You probably won't hit day one DSCRs. So that's really kind of the downside. Is it's really for those stabilized, which are still great cash flows, or still great cash on cash. You can do great investing, but it's not that 1, 2, 3 year guy who's going to make some cash on cash and then sell and make a huge, upside on the sale. That's not what this vehicle. This is, I guess you could probably say, more of a buy hold strategy.
Are there any legal considerations that you could share? Let's say for the passive investor that's listening, who's looking at deals to invest in that maybe, are looking at agency debt versus, say, a local lender, credit union, something like that?
It can really go both ways. Again, it depends on what your strategy is. The Fannie deals will let you have what we call the org chart, or the investors and the passive investors. I will say, I guess about 2018, Fannie really started looking hard at crowdsource deals. In fact, we had probably a 6-month period where I personally had 8 deals that we just couldn't get Fannie to agree to buy them. And so the market really turned. Now, Fannie's not a no, but I can tell you the struggles we have with Fannie, even though the property qualifies, even though the principal, or what we call the sponsor, kind of qualifies, we are getting a very hard look at the true crowdfunding. And when I say crowdfunding, I mean those investors who have hundreds, if not thousands, of $2,500 investors. I mean, if you come in with a group and everybody's $25,000, $50,000, you usually get through that. But if it's a true crowdfunding, we've done a couple of those deals where it really took a lot to get Fannie to agree that on the back end they would buy that loan. And remember, that's important here. Remember, Fannie and Freddie don't loan money. They don't originate loans. They buy loans, and then they sell them as a mortgage-backed security. And as part of that, they guarantee to that trust who owns it that if those payments aren't made for principal and interest, they will make those payments for them. So it's an insured investment on the back end, which basically frees up liquidity for lenders to borrow, to loan more money.
I know we've talked about it a little bit, but I wanted to ask you again, for let's say the listener that's an operator, especially a newer operator that hasn't, done agency debt yet, some considerations, things they need to know. Like I said, I know you mentioned a few things, but I wanted to specifically ask about that. So for that, like I said, that listener who's, they haven't done agency debt yet, and they're thinking, okay, I know you talked about some requirements for the loan and for the property, but anything else?
There's not a whole lot. You can, let's say you have a multifamily deal right now. They do refinancing. They have that available. And so from an actual operator standpoint, it's just like any loan. And so I think one of the other things is, your actual underwriting, if not every single time, is going to be what we call a DU, a desktop underwriting system, a DUS. And so it's going to be the actual lender you have. And I think that's one of the things that I think I would probably stress, again, is your lender relationships can get you a long way as well. And so I think, again, there's a little bit of misconception that you're dealing with this government program, and really you're not. You are dealing with, and now it can come from both sides. I've had a lot of lenders kind of push back and say, oh, well, Fannie, and they kind of use that as a wall to not negotiate. Not really true. Sometimes it is, but an experienced lender and or, real estate attorney or counsel can kind of guide you through. And I can tell a client in a matter of seconds, usually, hey, what is it you're trying to do? I.e., we want to have this completely unique organizational chart where so-and-so's manager and we want to switch back and forth. Not going to happen. But if there's some little things we can do in there. So for an operator standpoint, I think it's just while you're operating, before you do that, I would say the biggest part is getting the relationship with the lender who can do Fannie Freddie deals. And they'll be able to tell you they don't have incredibly, but again, it's all up to the individual lender. But if you are comfortable with the lender and the lender knows you as an operator, chances are that lender will underwrite you, even if maybe you don't have 10, 15 years of operating experience. Because I think that's another one of the misconceptions is, well, I haven't been doing this for 30 years, so no one's going to loan me money. Most of the underwriting is on the property. And that
right there is just great to hear. I know it's great to hear for most of the listeners who are newer to this space, right? I mean, most underwriting is going to be done on the property. Find the great deal. Obviously, they're going to want to see experience on your team, but it's relationships, right? Find people, to partner on that first deal or two that has that experience, whichever you do not have.
Lionshare Bookkeeping believes the key to generating wealth is understanding where it comes from and where it needs to go. They provide bookkeeping and financial coaching exclusively to real estate investors, focusing on cash flow, strategy, and action. Go to lionsharebookkeeping.com/apartments to connect with them now.
Are there one or two things that you would say, especially over this last year, that cause people to fail when trying to get a loan or agency debt?
So in general, I think going in, I think you even said this earlier, that the unrealistic expectations. If you're buying a property and you're at some 2-3 cap rate or something like that, and you think you're going to walk into a lender and get any kind of loan other than, now, with that said, I have done a deal, actually did a deal last year with a 3.25 cap rate, but the only loan they could get was a 60% LTV. And so, which for the deal, probably it really wasn't bad. And the client had, source funds to get it done, and we were able to get it done for them. But it's that knowing, I think you have to educate yourself before you go talk to a lender for two reasons. You don't want to be taken advantage of. Lenders do this every single day. And so that term sheet, one of the things I constantly counsel my clients on is the difference between the term sheet and the loan documents, and the reality that I still have clients who've done this for a very long time, who basically just look at the top lines of that term sheet and says, oh, great, interest rate. Oh, great, amortization, LTV. Those are all and then they don't read the next 8 pages. And we've gotten into a couple of deals, again, knowing your property, knowing the property, especially if it's a buy, getting that rent roll, knowing where it comes out, because they're always qualified. that top LTV will say, we'll give you 80% LTV. And then you get down to actual paperwork and it says subject to underwriting at a 1.5 DSR. And so if you know going in, don't sign that term sheet. I mean, because you've put all this money and time, and usually you're doing loan on the back end after you've done all your due diligence. And I've had a couple of deals fall through where it didn't appraise, but the reality is, based on the actual financials we had, we could have known that from day one. And so I think that's a misconception or misunderstanding, is if a lender gives you a term sheet, it's the same as lender saying, we're going to give you what's on the top of that page. And all it is a lender saying, we like what we see so far, but let's see what it really looks like.
Important to know what it really looks like, right?
Yes.
Now, Drew, I know you work with lots of operators. You see lots of deals. I'd love to know, like, how do you like to see an operator to be prepared for a downturn?
That's an interesting question. There's not. I mean, we had in several years ago. So just to back up a little bit, when I first came into the real estate was after college, was 2006, great, 2007. I was in real estate in 2008. So that was and I was kind of new to it. And so really there's really only one true answer. There's a lot of things you can do strategically in your legal setting up. One of the things we look at is cash calls. I remember doing a large deal in 2008, 2009, where it was smaller, $25,000, $30,000 investors who didn't look at the OA, the operating agreement, and realize that there's a full cash call provision. And so for those who don't know, what cash call means is if the entity, if the property usually, if it's losing money, a cash call literally means the managers of that organization can send out an email and say, guess what, everybody? There's 10 investors. We're $1 million short. We all own equal shares. I need your $100,000 check by the end of the month. And so really looking at, and so while you can't necessarily prepare for the ultimate demise, you can prepare for not having to come in with more than you originally thought you would have to. And so that's one of the biggest things is, as an investor, especially as a passive investor, I know it's 60 pages. I know it's 90 pages, but please read the document. Some of them are crystal clear on what will happen, and it still comes as a shock when it does actually happen.
Make sure they have a reserve budget. Right.
Yeah. Make sure that reserve's in there. Well, I was going to say the one true answer to any downfall is cash is king.
That's right.
But we also work in the real world, and, we don't all just wake up with millions of dollars and, in cash. So the reality is you got to balance those two. You do need cash reserves. That's in always in any investment, any sound financial investment, there's got to be a cash reserve.
What about any predictions that you have just for the real estate market over the next 6 to 12 months?
The odd thing is, before coronavirus, I always used to tell people my crystal ball is broken, but now I tell them it's just smashed. And so the reality is, I think we've gotten through what we need to get through. I think real estate, and the reality is in the multifamily sector, it's really done pretty well. In fact, just going back to the Fannie and Freddie, that's the absolute majority of their portfolio, especially over, I think they did, $165 billion, last year on multifamily deals. And so in that sector, I think real estate, I think it's here to stay. I think the one thing that concerns me is, are we going to be in that 2008 real estate bubble again? Because prices are just, they're going sky high. But I think on the other side of that, again, using my actual real estate finance degree, if you look at overall numbers, it's interesting, I was actually having this conversation with a finance professor about a month ago, is you can't just look at one side of the equation. Yeah, real estate prices, because he was looking at sales prices. But if you look at cap rates, if you look at, cash on cash, if you look at those, they actually haven't gone so far out of whack. And because rents have gone up. And so when you're looking at the entire deal, and so if you stick to your metrics, if you have a good metric that you like, it's just like any kind of investing. When you do the one that going in you're uncomfortable with, that's usually the one that ends up biting you. I can't tell you all the time, they're like, oh man, I love this market. I love doing the 50 unit deal. I love doing them at a 6.5 cap. I love this cash rate. I love this metric. And then all of a sudden they're sitting in front of it, but this is too good of a deal to go buy. And, it's not their metrics. And then 3 years later, 2 years later, whatever, well, that deal didn't end up working out. And it's, well, yeah, because you knew it wouldn't. So that's really the thing is, if you're comfortable, if you're in your niche, if you have your metrics, just keep to them.
Yeah, there's definitely a lot of value to be had in focusing, right, and staying in your lane, and having those metrics like you're talking about, or thinking wisely before you change courses, right, or pivoting, or especially changing metrics or underwriting and what will work. What about Drew? Any daily habits that you were disciplined about that have helped you achieve success?
Honestly, my saving grace is my team around me. They honestly do a tremendous job, keeping me number one focused. We like to have fun here at Patel Gaines as well, so I will say that. But keeping me focused, keeping me on task, making sure we're meeting and having that kind of that person to push back. And so really, one of the things I would definitely say is surround yourself with a good team, whether that's an actual team member, bringing on a staff or something like that. But, one of the things when I was in college and undergrad, I actually did, some charity work for financial responsibility type for high school students. And it was amazing how some of those people, and this was whatever that is, 10, 15 years ago now, I still get contacted by some of them who came from some pretty basic means, I guess I would say, who are very successful right now. And, the emails and the phone calls are pretty gratifying to say, hey, when you stepped in when I was 16, and so I think that's the biggest thing is the support system, talking to people who've done it. One of the things I do love about the real estate community is being an attorney who's worked in other areas. Some are so protective of their intellectual property, what they call it. Real estate folks, men and women, for some reason, I consider myself one of them. We love to talk. And we will tell you about our experiences. We'll tell you about the good ones, and we'll tell you about the bad ones. And so really having kind of even mentorship or people just who have done it before, so you maybe don't do it and do it wrong. I think that's huge. I think that's important.
What's the number one thing that's contributed to your success?
Again, I think my thing was just focus. As I said, from a young age, when I got into real estate, I realized I want to know everything about real estate. And there were several people who were like, well, you can't really know everything. And so I just started doing any and every job involved in real estate. And so I think it's just, it doesn't have to be a laser focus, but I think it's just figuring out what you are. Either you're good at it, you want to be good at it, but you have to love it. I have in the past experienced, whether it's a client or who just really aren't technically interested in real estate, but they love money. And so, but sometimes that just doesn't work out. I tell a great story when I was managing that, $85 million portfolio. You have to love your job, because I was literally at one point in a suit and tie with investors trying to get a deal done and got a phone call from a tenant who was having this dispute with the next tenant about a dumpster and had to go show up and climb in a dumpster and prove whose trash can who was using. So you have to love your job to be able to actually do that and not be like, yeah, this is it for me.
That's a good story right there. Maybe we should talk about that story on another show. But that's it's so true, right? You do have to love it. And I think any entrepreneur, as you begin a business, man, you better love it, right? Because you better be ready to get kicked in the face numerous times. I know the listeners have heard me talk about that and get ready to get back up. If you don't love it, it's going to be hard to get back up. That's for sure. Well, Drew, how do you like to give back?
I'm sorry?
How do you like to give back?
So giving back for me, again, is really what I appreciate is mentorship. I love to talk to, whether it's in my company and, law clerks, or really just teaching people, hopefully teaching them what I know. I think it's a valuable lesson. And even if, again, they're not expressly interested in the topic matter, it hopefully instills in them a willingness to learn, because this, my profession, I don't think people realize the law literally changes daily. And so we have to learn every single day, every single matter. And so just staying on top of that, my giving back is really just, as I said, I've done some mentoring things. I really like high school level personal finance, because I think that's where it all starts. And I think, just candidly, my own personal opinion, I think that's one of the things missing from our high school education, is a personal finance course, or just a finance course in general.
I agree. I was not taught anything about how to balance a checkbook, in high school. It just taught the importance of it, right? Not at all to even think through that. Make sure you got enough money in there. It could be that simple, but yeah, I agree completely. I appreciate you sharing that, giving back in that way, and I just love the thought, of how mentoring others, and helping them pull others up, with you as you climb the ladder as well, whatever your ladder is. But Drew, pleasure to meet you and have you on the show. I've enjoyed doing numerous shows with your group there, and just an amazing team, that you all have and experience in this business. So thank you for just sharing today about, how working with Fannie and Freddie and the ins and outs, pros and cons, things to think through as a past investor, even as a new operator, things you need to know, as you're looking at getting that agency debt. So Drew, thank you for that. How can the listeners get in touch with you and learn more about you?
So you can, I think probably the best way is to either myself or my firm, just look for Patel Gaines PLLC's website. It'll have all of our information. We do a lot of real estate law. We do actually property tax law as well, which is huge in any kind of real estate investment. And so you can just go on there and find my contact information, and reach out to me if you like.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.